G'day and welcome to the first weekly wrap of 2019. Chris, myself and the rest of the Edward Street team hope you enjoyed the break. I'll pass you over to Chris now for a recap of calendar year 2018.
Thank you, Cameron. Well, reflecting on the last year, we kept waiting for the Christmas rally to arrive, but it was a gloomy old Christmas. Our market closed at its 12-month low below 5,500 points on Friday, December 21st. Since then, we've seen the ASX 200 recover by almost 7%, and this compares to an annual range of about 16% over the last year. So we've made up almost half of the annual range of last year in less than a month. As they say, you can't time the market, but if you try, you'll likely miss the biggest days. But what if you could time the market? What returns could you have achieved over the last year? Well, as it turns out, the three top performing stocks on the ASX 200 were tech stocks, and they were all up over 100%. Payment solutions provider Afterpay has had a range of almost 300% since the low in early April until the high at the end of August. Had you bought the stock at its April low, you'd be up by almost 170% today. Funds administration software provider Bravura Solutions is up by 144% since February, and logistics software provider WiseTech Global is up by almost 110% since April. The only other stock up by over 100% from its 12-month low is gold miner Saracen Mineral, up by 107% since February. So, what were the poor performers? Well, there are 10 stocks in the top 200 that are currently down by more than 50% from their 12-month high. Leading the way is baby formula manufacturer Bellamy's, down by 67% from its February high. So why is it down so far? Well, there are some hold-ups in allowing them to sell their Chinese labelled products into China. But as you can imagine, if they can get it sorted, it will be a huge win to be able to tap into that massive market. Granite miner Sierra Resources is down by almost 60% since March 2018, although it's had a huge run since December 21st, up by almost 40%. Finally, Australia's largest automotive group, Automotive Holdings, is down by almost 60% since July last year. All of these stocks had an annual range of over 160% over the last year, so it has been a wild ride. Still, the winners have won by far more than the losers lost, so it's not entirely bad news. Now, talking about winners, what have you got in store for us this week, Cameron?
Yeah, thanks, Chris. The stock I'm going to talk to you about today is not for everyone and would be appropriate for speculative investors. That is Whitehaven Coal, ticker code WHC. Whitehaven, as the name suggests, is a domestic coal producer out of New South Wales and runs numerous operations. Yesterday, Whitehaven reported a strong second quarter update with output rising by 11% compared to its prior year. This was primarily aided by record production from its Maules Creek mine and increasing output from its Narrabri operation. In our view, Whitehaven looks in a comfortable position to meet its FY19 guidance of 22 to 23 million tonnes of saleable coal. So why do we like this stock? Well, we believe Whitehaven has a strong capital management outlook. This is a result of significant cash being generated by the business with strong margins and increasing output, which has allowed the company to improve its balance sheet over time. Our analyst expects Whitehaven will move to a net cash position this financial year, in addition to distributing a yield of more than 10%. Put simply, should the Aussie dollar remain low and the coal price remain resilient, which is what our analyst expects to happen, then we should see higher prices in the stock price and significant capital returned. However, like any commodity-based company, there is operational and commodity risk, which investors should consider prior to investing. The recent pullback in the share price has provided the buying opportunity, which our analyst has 23% capital growth potential from its current share price of $4.71. This puts the stock on a buy recommendation. Thanks, Chris.
Thank you, Cameron. Please remember that our comments in the video are general in nature And please speak to your Edward Street advisor if you wish to know if any of the stock recommendations suit your personal needs and objectives. We'll see you next week. Bye.